Welcome to the Short Strangles Masterclass. So I'm going to show you everything you need to know on how to trade this strategy and exactly what I did to use the strategy to make $2,900 last month, even though it was a crazy market. So let's dive in. In this course, you're going to learn exactly how I did this. Again, you can see here, I brought in $12,000 of credit, which led to about $3,000 profit that I actually took home and closed. Here's the back test that we'll be going through. 97% win rate, or very consistent strategy. I'll also be showing you different tweaks you can make to the strategy to make it more consistent, more profitable, and have lower risk. And again, here are some results from others who are doing strategies just like this that I've taught them as well. So here's the game plan for this training. Number one, why trade the strategy? Number two, how to structure it, the DTE, the strike selection, and everything that you need to know about it, how to manage it, take profits, stops, management, things like that. What is the risk that we have to worry about, and how do we account for that and plan for it so that we have lower risk? How do we size it with our account and scale up as our account grows? How I personally trade this strategy, and then how to do it in different markets, like a bullish market, a bearish market, a sideways market. And then I'll actually show you a real trading example. So we'll go in, I'll share my screen of a trading chart of my broker. I'll show you how to pick the strikes and everything you need, so that by the time you get done with this video, you can actually put this into action. So this is actually going to be an in-depth full course that I guarantee some people will charge thousands of dollars for, but you're going to learn more from this free video. So stay tuned. Okay. I'm also going to show you a quick bonus of how to automate the strategy if you don't want to do it yourself. Sweet. Before I get into it, legal disclaimer. Again, this is for educational and entertainment purposes only. Trading is risky and 99% of people lose money. I will be showing past performance, like mine and other people's, but that is not guaranteed future results. So don't bet the house. And also take 100% responsibility of your own trades. If things go south or go wrong for you, understand it's your broker's fault, not me. Just kidding. All right. If you agree, then again, let's watch this training. If you don't, you should probably stop watching. But let's dive into the good stuff. Why trade the short strangle, and how has this made me $3,000 over the last 30 days? It's a simple mechanical trade. You don't need to guess. You don't need to hope. You don't know, maybe this is happening. Maybe no, every single week you do the same exact thing, which makes it very predictable. There's no complex chart reading needed. You don't need to read the chart. You don't need to understand what it's doing. Yes, you can use it to gain an advantage, which I'll show you later, but I don't even read the chart anymore, and I'm still able to do this successfully. And I'll show you how I do that with my setup. You can easily scale this. It's both friendly for large and small accounts, and I'll also show you how to scale that later in this training. It has a very high win rate, 95% or higher. It's great at generating reliable monthly income, which is what it's doing for me. This is the actual strategy that I've used that's been able to generate enough money to retire my wife, who's a full-time public school teacher. There are also multiple ways to win and exit with this trade. Now, how do we actually structure this trade? Let's get into the fun part, right? How is this structured? First off, we need to understand the goal of this trade. The goal of this trade is to generate consistent income from theta decay, okay? Our goal is to let the trades play out, let the option generate us money by allowing us to collect credit, and the theta decay over time is actually generating us that profit. When most people do short strikes, it's somewhere between 90 to 120 days out in the future. We do this with our strangles because, again, you'll hear this in the risk section, but the further out in time we go, the less risk we take, the higher our win rate, and the more profit we make. But we'll go over that in just a second. So 90 to 120 days out. Now, how do we pick strike selection? It's typical to do a one standard deviation. That means 16 delta put, 16 delta call. If you're not too familiar with what that means, don't worry. When I get to my broker section, when I go into the broker, I'll show you exactly how to pick these levels. Target credit is $30 or more. So if you can't get $30, it may not be worth the trade for you based on a risk to reward basis. So you're looking to collect at least $30 in credit. That means when you put the trade on, you'll get a trade price of $30, or you'll receive $30 in credit. Ideal assets to trade this on is going to be futures options, because you get the highest leverage and return on your money. So that's going to be things like ES, CL, GC, and also ETFs, because they track the overall market. And so they're going to be less likely to move due to a single news source. And those will be things like SPY, IWM, QQQ. That's a bit more volatile. But anyway, using those assets that already have the built-in diversification will really help with the short strangle. So how do we manage this? Once we've set up the trade based on these rules, which I'll walk you through in a second, how do we actually manage the trade? Take profit typically ranges from a 25% take profit to a 50% take profit. Your stop loss is around 300%, or you don't. And some people use a 21 DTE rule. So I'll be talking about which one's best, but let's just go through an example here. So if you did receive $30 of credit for this trade, a 50% stop loss would mean that you close the trade once the trade is now trading at $15. So it goes from $30 to $15. Once it does that, you'll close out the trade. Now for the stop loss perspective, let's say it's a 300% stop loss. If you got in at a $30 credit, we're going to multiply that by 3, so you'll get out around a $90 credit roughly. And then the early management is 21 days. So that means, let's say we got in the trade at 90 days. Once there's 21 days left in the trade, so once the DTE for that is 21 days away from the expiration date, you'll close it. Now, again, if I'm getting too in depth, don't worry. I'll be sharing my screen in the brokerage showing you how to identify all these numbers. Now, here's the 3 biggest risks when it comes to using short strangles, because generating income is great, but if you don't consider the risk, you're just going to always screw up, right? If you could take away your 3 biggest trading losses in the last year, I bet your overall wins would be a lot greater, and you might even have a net win, right? So if you could just decrease your losses or stop losses in the first place, you're going to be a way greater, way better, more profitable trader. So what are the 3 biggest risks? Number 1 is a market crash risk, okay? The problem with this is if the market crashes, that would result in a big loss because VIX, the volatility index, is going up, which is making us lose. And our puts, most likely, again, if it crashes, our puts, a part of the shingle, will get hit, and we'll see some big immediate losses with that. And so the solution here is to, number 1, we can only enter on red days. This means that when the market's going down, that's when we enter a strangle. We can do it that way because now VIX is elevated, so we can take advantage of that. We're selling the volatility premium. So basically, when VIX is higher, if we sell there, then when VIX drops, we immediately see that profit. So that helps us profit a lot faster. Also, when we enter on red days, it allows us to get wider strike prices, which increases our win rate. So red days are great, but it's not going to solve your problem, but they do help. We can also enter on high VIX days. Like I said, this will help, but it's not going to solve the problem. We can also use indicators to show us when the market is overbought or oversold, aka when the market is too high and it's likely to crash. And I'll be showing you different indicators that I use to warn me of that so that I can get out of trade before that happens to help me avoid a lot of risk. Again, you still want to avoid everything, but this helps reduce 90% of market crash risk. Next is risk number 2, which is manipulation risk. This is common to all options trading. If you traded options before, you've experienced this. Stop losses and limit orders on options specifically can lead to losses due to market makers manipulating the options price. What I mean by this is when you put in a limit order, when you put in a stop order on an option, that order then sits on the market. And anybody like a market maker, a hedge fund, a bank, anybody who wants to take advantage of that can. All they do is they look at that order, they see what price it's waiting on, they go to the option, they manipulate the price real fast by putting in some fake buy or sell orders. It hits your order, they're able to take it and then re-profit from it. And so if you've ever put a stop loss on an option, you know how much it sucks, you know how much it triggers prematurely because of this, and basically you're losing hundreds if not thousands of dollars from this manipulation. So the way that we solve it is by only submit an order when you're ready to exit. So if you're timing, if you're ready to enter, then go enter. If you're ready to exit, then exit. Don't use a stop loss and depend on that. Now, what I'll be showing you here in the last section of this video is actually how to automate your trading using some other platforms. And I'll actually show you how you can solve that problem with this as well. Now, risk number 3 is the volatility risk. Okay, so the problem here is when VIX spikes, which is volatility, when risk in the market is higher, this can lead to sudden losses when VIX goes up. And so as an option seller, VIX goes up, we're going to start losing money. And so ideally, we don't want to do that. And so we can solve this by adjusting our buying power usage based on where VIX is. The lower VIX is, the more risk we have. So if VIX is lower, we're going to be in less trades. As VIX goes higher, which means it's more in our favor, we'll then put on more trades. So let's say, again, we'll get in this in the sizing section next, but again, you can size your trading based on where VIX is. So let's talk about account sizing. How exactly do we size this and scale it? So account sizing, again, in general, we need to keep in mind the 30% rule. This means have no more than 30% of your account in trades, right? So if you have a $100,000 account, you should have no more than 30,000 in trades. Now, again, this may seem like it's on the low side. Also, why can't I use 50, 60, 70%? Especially if you're trading futures options, the buying power of those trades can really spike. And so we just need to give ourselves a lot of room for margin. Again, it just increases the safety of our trades so that we can actually do better as a trader. And again, $100,000 account, which means you should have about $30,000 actively in trade. So again, you can determine that for your account size. So based on that, how do we scale this trade? Okay. Number one, if you have less than $10,000, you're looking to do one trade at a time, only having one trade open at a single time, and using SPY or MES, aka smaller assets to trade with. And so again, you won't be doing any of the big boy ones yet, like ES or SPX, but do one trade at a time on SPY or MES. If you have 10 to 25,000, you're going to be doing about one trade per week on one of our smaller assets like SPY or MES. If your account size is 25,000 to 100,000, you'll be doing 1 to 3 trades per week on SPY or ES. So then again, you'll start going there. This is where I am. Again, I have about $100,000 that I'm using for this strangle strategy. And so only about $25,000 to $30,000 of it is ever in trades. And I'm doing 2 trades a week on ES. And so that's what my current setup looks like. And then also on this, if you have $100,000 or more, you're doing 1 to 3 trades. And then again, per week on ES. And then from there, you don't really want to do once every week. Instead, you just want to size the contract size. And so you'll go once to twice to 3 times a week. After you hit 3 times a week, start scaling the contract. Go from 1 short strangle to 2 to 3 to 4 each time. So the goal is a 10% return on your invested money every month. This is what I am able to get myself. Again, it doesn't mean you'll be able to do that, but this is roughly where I land. So again, if I'm having roughly $3,000 invested, I should be making about a 10% return on that. Again, this is based on futures options, because futures options give you that great leverage. So that's why I'm making about $3,000 a month, because I have $30,000 invested in trades, and I'm making about 10% of that investment. So I'm making about $3,000. So that's how the math plays out. All right, cool. And so now you may be saying, sorry, my face is blocking the business. What about, I just moved my face over here. Sorry about that. I should have thought of that beforehand. What about the unused money? So if I have, let's just for easy, $100,000 account, only 30,000 of it is in trade. So what should I do with the other 70,000? That should stay there as liquidity for your options trading. But what I've seen a lot of people do, and something I have done in the past, it's something I'm actively doing though, not for any reason, just because I haven't gone into my broker and done it, but is investing a portion of that money into T-bill. Okay. This is an ETF of the treasury bills from the government, are very reliable, very safe. And currently they're paying a 4% yearly interest rate. Now, since this is an ETF, we don't get that interest, but instead what we see is we get paid a monthly dividend. So it's roughly, I forget what the exact number is, but around 0.002 or something percent dividend on a monthly basis, which translates to roughly a yearly return, which is great because that's money that's doing nothing, that's just sitting there. We can then put in T-bill to generate extra money. Perfect. So how do I personally trade this? So I showed you how the overall market does, best practice, things like that. But how I personally trade it, which again is up to you, you can decide if you like it or not, is this. My goal is to safely generate monthly income. And so I'm not trying to just generate monthly income off of theta decay, which yes is the base of this, but I want to do it safely. I'm okay with less profit if I have a higher win rate and can control my risk a lot better. Because again, this is my retirement account. This is what I'm using to supplement income so that my wife can retire. And so I want this to be reliable, right? And with it, this is what I do. Days until expiration, I go 120 days out. Why? The further out in time we go, the more time we have for the trade to play out and in our favor, which means the lower risk. So with further out, I go in time, I get to have a higher win rate, I get to collect more money, and I have lower volatility risk. The only downside, I have to wait longer for my trades to finish, but that's okay. Strike selection, how do I pick my options? I skew my strangle. And a lot of people don't do this, and I don't know why. Again, I've been doing this for almost a year now, and I absolutely love it, but I skew my strangles because in general, the market tends to go higher. Guys, if you just look at the market over a 10-year, 5-year, 1-year time span, most of the time it's going higher, it's moving up. And if that's true, I don't want to have it in equal distance. I want to have a higher distance up here and then a normal distance here. Why? So I can allow the stock more room to move to the upside, so that's not always breaking my call price. And so if we see here, strike selection skewed, I'm going to do a 10 delta put, 5 delta call. So I have more room to the upside in case the stock continues to move that way. Credit target, I'm targeting about a $35 to $50 credit, which is pretty good. My take profit, I'm taking profit about 25%. Why? Because I want to get in and out of these trades. I want them to be quick and easy. And so that's typically what I do. A 25% take profit leads to me exiting a trade basically every 2 weeks. So I only have a trade open for about 2 weeks. Next is early management. I don't do a stop loss on this. I do a 21 days management. This is a TC Live type of mechanic, and you'll see the back test here in a second, but it really helps smooth out the curves. Now, this can bring a lot of risk because, again, you have these trades open during market crashes and you're not really closing it. So that's why you want to make sure that you're using no more than 30% of your account. And then also you're sizing that with VIX so that you can control your risk and sizing that way so that you can stay in these trades longer. So allocation is 30% of my account. And then I also change that based on VIX. So if VIX is low, I'll only be using 15% of my account. If VIX is higher, which means I have less risk, I'll use all 30% of my account. And so safeguards, like I said, I adjust trading size based on VIX, like I just said, and I use an indicator to predict market crashes before it happens, which I'll show you here in just a second. Now, here's the back test of my personal one, which you can see very consistent, but there is one huge caveat to notice. Yes, we have a 99% win rate. Yes, it's a very smooth curve, especially when we compare it to the original backtest, which is this one. You can see here a lot of ups and downs because of the very minimal but occasional stop loss that gets hit. It leads to larger drops and losses. And this one doesn't have that because, again, we stay in the trade longer. But here's something to notice, okay, is 2020. You can see right here, that was 120% like temporary, like an unrealized loss. And so what I mean by that is I would have had to withhold through that. So how would I have survived this? Again, 2 ways. Use indicators. I'll explain here in a second. But even if I didn't get out when an indicator signaled, how would I have survived this? You can see here, my account value dropped 120%. Okay, so 120%, that's actually not bad. If I only have 30% of my account in a trade, then that means that 120% would then be 120% of my 30%. So I would then be about 70% of my account would then be used up for my trades. And I would still have enough buying power to withstand this move. And so I would have been able to hold on and go through it. Now, again, I've been trading this since about 21, 22. So I haven't gone through something like this. But again, I have gone through temporary VIX spikes and I've had no issue because I leave so much room for margin and money that I'm not using so that I can let the trade play out and let the trade win. So here's how to trade the short strangle on different markets. Yeah, bullish markets, and then those look like higher highs and higher lows. The bullish market means the market is trending higher. For that, we'll follow the ideal trade setup, which is going to be where you skew the strangle, where you give it a higher upside and a lower downside so that you're not hitting that top too much. And bearish markets, this means that there's lower lows and lower highs. The market's moving down. And in this instance, you want to stay out of the market. Ideally, I just like to get out entirely because I don't want that risk right now. But if you want to be in the market, you should probably reverse the deltas. So you have a 10 delta call and a 5 delta put. So you give yourself more downside room since the market's moving lower. And then in sideways markets, that's again where we're staying at a certain resistance and support, trading between 2 levels. In that market, again, you can use this skewed strangle, 10 delta put, 5 delta call, or you can even go 16 delta, 16 delta if you want to be a bit more risky. But what are the advantages of using this strategy before I share my screen and show you the charts? It generates consistent income. It's great. It's very easy to set up. It's just 2 options you need to worry about. Requires very little adjustment, so you don't really need to do anything. You put the trade on and you close it out of take profit, basically. They can be stacked for continuous income. So like I said, I do twice a week. So then I have 4 trades, 5 trades, 6 trades running at a time that are waiting to hit profit, which is nice. It plays both sides of the market. So for instance, I have a put and a call. So if the market goes down a bit, I'm still making money because of the call that is losing its premium. If the market goes up, well, I'm making money from the put. So it plays both sides, which is great. It also works in all kinds of ways. You can do it with so many different assets, different expirations. You can change the deltas however you'd like. And bonus, it can be used to buy stock at a discount. If you're trying to generate, let's say you wanted this more on an asset that you want to eventually own, like a stock or something, you can run a strangle. And then whenever your short put gets hit, you can just get assigned. And now you have the shares, which you're able to generate income before you got the stock. And you also get it at a discount now. Now, what are some of the disadvantages? Because we always need to know the downside before we do something. Okay. And it has the potential for very large losses. If you do a 200 to 300% stop loss, you will have large losses. It's fine because all your winners will outdo it again, as we saw from the back test. But even if you don't have a stop loss and you're holding through, you'll still have to hold through a lot of big losses. And so it can also be complicated if you're new to options, which hopefully I can break down here soon when I share my screen and go into the broker and show you what buttons to click. It also requires very strict buying power management, meaning you need to make sure you're controlling your buying power, know how much you're using, and make sure you're not going over that amount. It may require hedging. If you want to be super duper safe, you can put out some hedges that will cost you money. But there's also uncapped downside risk, and this is an undefined risk trade. There's also assignment risk. Again, if your levels get broken, if you're not doing futures, you can be assigned. Let's look through a real trade example. So I'm going to jump into a whiteboard, kind of walk through, make sure you understand how this is set up. Then we'll go to the broker. Then we'll look at the risk profile. So if we're explaining the strategy again, just to make sure you understand, let's say this is a stock, right? It's moving up, doing its own thing. Let's say the stock is trading here. What a strangle is doing is I'm betting that I'm going to stay between two levels like this. So as long as the stock stays between these two levels, I make money. This is all a strangle is, like this. If it goes like this, I make money. If it goes up, it stays below. If it goes down, it stays above my level. Any one of these, I make money. And it's so much better than stocks because with stocks, I only make money if it goes up, I lose if it goes down. This way, it goes up, down, sideways, whatever, I can still make money in this trade. Now, instead of having an equal distance, because as you can see, in general, the market trends higher, what I do is I move my call higher. So this way I have more room to the upside that I can slowly go like this and I'll still make a profit because I'm in this level, but gave it enough upside room. And so that's exactly what a skewed strangle is and what it's doing to profit. So again, I sell the put, sell the call. Each one of these gives me money and then I get to do what I want with that money and I close at a certain take profit. So that's how it looks like. If we're looking at this on a real chart, you can see here the market tends to move higher. So that's why I skew my strangle so that I have more upside room. But what I want to look at here is ways to reduce risk before I get into the broker selection, okay? So like I mentioned, it's super easy to put this trade on, which I'll show you here in a second. But one of the biggest things we can do is purely by just controlling risk and knowing when the market is at the highest risk. And so if you go to indicators and go to Bollinger Bands, I know most people don't do this, but you can actually do this here, just like this. And I like to make a few settings. So I go into the settings of it. And in the inputs, I change the length to a 200. This means I'm changing the middle line to a 200-day moving average. And basically, whenever the market starts to break out of the top range, then I know, hey, it's very likely the market will pull back. And so you can see here, particularly what I wait for is a break above and then a break back down. So you can see here, we broke above it, then we broke back down. Again, these were some false signals as well. But this helps me know, okay, maybe I should trim a few of my positions, get out of a few trades, get out of all of them, maybe put on some hedges, or whatever it is. You can see here as well. You can see here, then we have these periods of down moves. And then you can see here, we've had some periods of down moves as well. Again, this isn't going to be picture perfect, but look at this. You can see here, we would have gotten out of the 2020 crash, out of this little move, out of this one. Again, it's going to give you some false signals because nothing's perfect in the market, but by using this little Bollinger Band trick, you can then actually get out of the market when it's at the highest risk, which is when it's outside of this trading range. And so again, that's how I use this to help give me an even greater win rate and lower my risk dramatically, is by looking at the market and understanding, am I at a high risk time or a low risk time? Again, if I'm inside this band, I'm low risk. If I'm above, either way, high or low, I'm at a high risk, aka a chance of it reversing. So that's how I manage risk. Now, let me jump over to my broker. So now that I'm on my broker, let's actually look at how to structure this trade. So you can see here, if I go to trade, again, I'm going to be looking at the ES symbol because that's my favorite way to trade it. Again, this is for accounts 25,000 or higher. If you have less than that, you can do MES or maybe SPY or something smaller. But anyways, you can see here, like I mentioned, how I set it up is I look for, actually, I'll just follow the rules here. 120 DTE trades. So what do? On the options chain, I look for strikes that are closest to 120 days. You can see here 0 day, 3 day, 4 day, 5 day. So I'm going to go closest to 120 day. So I have 98 day, 112, 132. 112 is the closest. You can see here, I already have a lot of positions on around here. But again, what I do is, again, like I mentioned, I do the 10 delta on the put side, which you can see here, I do have a position on, but I'll just do this again. So on the put side, which is the right column for the options here, I'm going to sell the 10 delta. So delta, make sure you see this here. And I can find the 10, so the 0.10, that's the 10 delta. I'm going to sell this one. Then I'm going to go on the left side, which is the call side, and find the 5 delta, which you can see here. I have one already, but I'm going to sell this one. This right here shows me that my max profit on this trade is $2,200, and I have roughly an 80% win rate. Not bad at all. When I add a take profit to this, a 25% take profit, that's how I boost my win rate up to 90% plus. But anyways, you can see how great this trade is. $2,212 is my max profit. It's the credit that I'm getting. So if I do that, 2,112, and I multiply that by my take profit of 25%, that means for this trade, I will make $500, which is awesome. Why is this awesome? I can make $500 in 2 weeks. Now you might be asking, how much money am I putting up? You can see here the buying power effect of this trade, how much money I have to put up to be in this trade is about $6,000. So then we can look at that math. If I'm making $500 and I'm putting up $6,000 to do it, I am making an 8% return on my money in a matter of 2 weeks. Now it might go a bit longer, but let's say it takes a month at the longest. I'm still making an 8% return on my money in 1 month. And that's how amazing that is. Again, if I can do that in 1 month, that's 10 times better, 20 times better than literally what the bank's interest could ever give me. And so 8% return is what you're looking at. And again, when I overlap these trades, that's where I hit my goal of about a 10% return on my money in that period. And so that's how I hit that 10% return on invested capital, or on the money that I have in trades. And again, this is that strangle trade. Now let's walk through take profit. So like I mentioned, if the max profit is 2,200, multiply that by 0.25. That's how we get the $500 profit. If you're doing a 300% stop loss, just multiply this by 3. And then again, once you get to a loss around that amount, that's when you'll close it. So that's exactly how a strangle works. Super simple to put on, just 2 options, close it, take it off. Again, this is you enter as a credit, you exit as a debit. So that's everything you need to know about the strangle strategy. Let's dive in, because I have a little bit more here to cover. So let's say you want to do this. I've given you everything you need to actually go put this into action. But again, if we're doing these strategies, it's because not only do we want the income, but we want the safety, and we want to have it be completely hands-free, right? We want to spend time with our family, traveling, doing what we love, our hobbies, hiking, whatever, maybe even spend time with your grandkids and your wife again. That's why we're doing this, okay? And so, yes, this is a great strategy. Yes, there are ways to lower risk, but how can we actually not use our time? And so that's what I'm going to show you how to automate this. Let's turn this into a bot, aka passive hands-free income. Okay, so there's a couple steps we need to follow, 4 steps exactly. So first step is we need to sign up for an automation software. Okay, we need to sign up for something that will allow us to automate our options trading. And so here's a few platforms you can use. Option Alpha, which again, it allows you to automate options. It has account safeguards to help you protect against some things. And it also offers paper trading. Trade Stewart's another option. Again, it automates options. It gives you access to most of the strategies, and it supports webhooks and other things like that. And then you have the Options Auto Trader. Now, I am completely biased because this is my company. I built it from scratch over the last year. We now have over 600 members and support over $40 million in connected assets, and it supports everything. We give you access to options, give you the account safeguards that I mentioned. We can control risk. We support all strategies, 112s, strangles, credit spreads, whatever you want, you can do, a calendar. We support all assets, futures options, which no other platform supports. So again, if you want to automate your futures options strangles, this is literally the only platform for you. We also video support. Literally, if you try to contact support at any other company, whatever. It's awesome. There's paper trading, test it out. So again, for this example, I'm going to show you how to do this through the Options Auto Trader. But again, once you pick an automation software, whatever it is, you then need to connect it to your broker. So the Options Auto Trader is the only one that supports a ton of brokers. The other ones only support 1 or 2, but we support tastytrade, Schwab, TradeStation, or Tradier. So if you have one of these, you're good to go. Next is you need to plug in the rules for the short strangle strategy. So again, take the rules that we taught there and just plug them into the options auto trader and just fill it out like a form. And then that bot will then be able to execute based on those rules. And then you just sit back and let the bot safely generate monthly income. And you can see here, here's some results that I've had from other strategies that I've been running. You can see here 7,500. And this was all done passively. Like I didn't even touch this. I just subbed the bot and it ran. If you're cool, let me show you a quick 5-minute demo of how this works. So if I'm on the Options Auto Trader website, again, I've already connected my broker. So I'm just going to walk through how to automate this, how to turn it into a bot. So I'm going to click on Create Auto Trader. This is what allows me to create a bot. I'm going to click on Create One from Scratch because I have all the rules built. So I know the rules and I just gave them to you, whether you trade them yourself or you want to automate it, you have the rules. So click on Create Auto Trader. Next, what strategy am I doing? We're doing a strangle strategy. Next, what we're doing it on, like I mentioned, if you're a smaller account, MES, larger account, ES, you can also do it on SPY or something else. For this example, I'm just going to set one up on ES. How far out in the future do we go? Like I mentioned, I go 120 days out. And then for the strike selections, how do I pick it? My put, I pick a 10 delta and I sell that. So -1, that's correct. On my call, I do a 5 delta and I sell that one. I also enter twice a week, but for this instance, we'll just keep it once a week and we'll do the middle of the week just because why not? And we can pick a specific time we want to enter or not. Remember how I mentioned that you can actually increase your win rate, increase how much profit you're making if you enter on red days. Just like that, you can enable this and now you'll enter on red days. Again, I'm not going to do that for this instance, but you can do that as well. Also, how do we manage it? Then I do a 25% take profit. I don't do a stop loss, but if you want to put that in here because you want to do that, you can. And then I close at 21 days. So this is how I manage my trade. Again, if you want to do something more advanced to manage it, you can. This is how I do it. Next, I'll continue on from here. And from here, I'll tell the bot how much money I want to allow it to use. So let's say I want this bot to trade with no more than 10,000 so that it only has 10,000 to trade with so that it can't go over and overtrade my account or do something weird, okay? But what I want to show you here is show more safeguards, okay? So like I mentioned, we can change how much money we're using based on where VIX is. And so with just one click, I can enable that to happen. So now you can see here, if VIX is higher, I'll use my whole $10,000 for this bot. If VIX is lower, meaning my risk is higher, it'll only use 5,000. So that way I can change how much I'm trading with, my trading size based on where VIX is. And so this is super duper helpful. I always have these enabled on my bots personally. Also the market crash safeguard, which I can enable here. And this means, hey, if it's breaking above the Bollinger Band, it starts to come back down, then hey, offload some positions, close out some trades that I can actually be safe and reduce my risk from a market crash. And so again, those ways that we said that the biggest risk for short strangles, just like that, with 2 enable buttons, we've eliminated like 80% of the trading risk right there, which is insane. Just like that, you can see an overview of the bot, all the rules you set, what exactly it's going to do. You can set it live and then save the auto trader. And just like that, based on your rules that you set, it will automate your trading strategy. Again, you can see here how it's doing. If I jump over to my other account, again, you can see here the 120 DTE ES strangle that I've been running. You can see here we have a few trades active, one down about 5%. We have a couple here making some money. Overall, $2,000 profit, and this has only been running for a month, which is insane. I literally, my first trade was entered on January 7th. This video is being recorded on February 7th, so you can see there, 1 month, $2,000, and I'm definitely going to scale this up. Anyways, that's exactly how you can automate your trading, which is super simple. Don't you guys think that automation and the Options Auto Trader is awesome? If you do, you can actually join the Options Auto Trader down below or go to www.optionsautotrader.com/get-started now. Whether you use automation or not, you now have everything you need to implement this and start making money. So go do it. All right, guys, see you in the next video.